Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Christian Magoon, founder and CEO of Amplify ETFs. Amplify offers about 15 ETFs, including some very interesting strategies for investors who are seeking growth, income, and risk management. And in particular, their Enhanced Dividend Income ETF DIVO has done very well this year and has seen a lot of interest from investors. This ETF uses both dividends and covered calls to provide high income to investors. So we'll take a look at DIVO, its strategies, and some other income ETFs that Amplify offers. We'll also touch on a couple of Amplify ETFs that have been out of favor. In particular, the blockchain ETF has been beaten down this year. And the battery technology ETF has also not done well, though it seems there's a lot of longer-term growth potential. So we'll talk about those two ETFs and whether it makes sense for investors to take a look at those areas now. Joining me now is Christian Magoon. Hi, Christian. Welcome back. Great to have you on the show.
Hey, thanks, Neena. Good to be here and happy kind of getting close to year end.
Yes.
Say goodbye to 2023 for most stock and bond investors, I think.
Most investors would be happy to. So very few areas of the market have done well this year. And dividend-paying stocks and ETFs are among them. They have been very hot this year. And income-hungry investors have poured billions of dollars into these stocks and ETFs. Your flagship ETF, DIVO, has also seen a lot of interest from investors, and it has done very well too. So we'll talk about that ETF and your other income ETFs, but I wanted to ask you about the interest in general that you have seen this year in your income ETF suite and whether you expect that trend to continue.
Yeah, we definitely have seen, elevated interest on the income side this year. I think just due to all the market volatility, not only in the equity market, but the bond market. So it's been a good year for, inflows into our income lineup. With DIVO, our largest and oldest kind of dividend ETF that also uses covered calls, kind of receiving, the lion's share of inflows over $1 billion in 2023. So we definitely believe that, investors have kind of shifted their risk appetite to becoming a little bit more value oriented than growth, and a little bit more interested in getting paid to wait via dividends than just banking everything on capital appreciation. And that's really kind of benefited our income ETFs and really caused us to expand that lineup, as well as we've launched several ETFs here in the back half of the year to provide some other types of asset classes or investment strategies that do produce significant income. I think the question, though, Neena, is will that continue in 2023? We're talking today after a big rally after Chairman Powell spoke, and if risk on comes back, I do think the market will switch more towards capital appreciation and growth stocks, and be a little less mindful of these dividend or kind of value-oriented strategies. With that being said, investors kind of have a little bit of a long memory. Some of these growth strategies have been down, significantly, 30, 40, 50%. And I think, that will stick in the back of their head initially, even if there is a rally, because I think there'll be some concern on whether or not that rally will last. So, if we see a risk-on environment, definitely I'd say less relative demand for these income strategies. if that's as it sustains, we'll see more and more, I think, money focus back on these growth stocks. But who knows what happens with 2023? It seems like a lot up in the air. Certainly, you could argue that investors over the last, say, 8 years have probably been too growth oriented, and the move to value may not be an overweight to value. It might actually be getting it more to a market weight of value, which is probably healthy in the long term for investors.
So now let's talk about your flagship ETF that you mentioned earlier. It is the Amplify CWP Enhanced Dividend Income ETF. Ticker symbol is DIVO, DIVO. So you mentioned that it aims to provide high income both from dividends and covered calls. So tell us a little bit more about the strategy, what exactly it holds, and how are those covered calls used to provide high income to investors?
Yeah, so this is one of our oldest ETFs, launched about 6 years ago, and really has had its day in the sun, so to speak, the last several years, as investors are more interested in kind of higher quality companies that are growing their earnings, growing their dividends, and then also, in this case, having a manager who can actively manage the portfolio, which helps with security selection, as well as gives them the ability to do some extra work and write covered calls on these large cap companies to generate additional income beyond dividend income. So, the basic premise of DIVO is to own high quality blue chip companies, about 20 to 25 companies that have a history of growing their earnings as well as growing their dividends. These are companies that are kind of similar to like Dow Jones Industrial Average companies. And the portfolio of DIVO is really kind of allocated across the 10 S&P sectors, or at least the traditional S&P sectors. Tends to be a little bit more value oriented than the S&P. So it has an underweight in some of the technology and communication sectors. But, you see companies like United Health Group or McDonald's, Chevron, Merck, Johnson & Johnson, Home Depot, Procter & Gamble, kind of meat and potatoes companies. So the manager, this is actively managed by Capital Wealth Planning, and that's a firm that's based in Naples, Florida, that's been running this strategy in SMA format for nearly 10 years. And then about 6 years ago, we launched an ETF version of this. They actively manage the portfolio in terms of security selection, and then also in terms of the ability to tactically write covered calls on some of these securities to produce additional income. So it's really a very similar, kind of blue chip strategy product to, high quality dividend ETFs, but it has really two engines for income instead of one. Traditional dividend income or dividend ETF would have one engine for income, and that's just the dividends companies pay. DIVO adds a second engine, which is, the ability to write covered calls on these companies. And, at any given time, there might be 3 to 5 companies that have covered calls written on them in a given month, for example, in DIVO. It's not incredibly active. It's really done to add some additional income. This strategy isn't designed to produce high income. It's really designed as a total return strategy, of which there's a fair amount of income. So, current distributions are right around 5%. Those distributions are paid on a monthly basis. So that 5% annualized distribution, allows you to get paid once a month. In general, the strategy over time has paid somewhere between 4 and 7% in terms of distributions, with about half coming from dividends and about half coming from covered call writing. The true kind of, I think, appeal of DIVO is not only does it have high quality companies, but it produces a decent amount of income. And looking back over the last 5 years, its annualized return is a little over 10% a year. And that's allowed it to become a 5-star rated ETF in its category by Morningstar, which is the highest rating. And it's in the top 1% of its peer group over the last 5 years. So I think that, double-digit annualized return, plus, the track record and the lower volatility than the S&P, and then, crucially being able to pay out income on a monthly basis has all just really come together and been, kind of the right product and solution at the right time given the market environment. So we're really excited to see DIVO grow and be recognized. 3 years into this product, Nina, there was less than $30 million of assets in DIVO, and it's because it really wasn't the right market for it. But it's grown consistently over time, and as the market has looked more and more for high quality companies and ETFs that pay more income, this has become one of the, I think, premier offerings in this area of the ETF marketplace.
Yeah, this is definitely a very interesting strategy. So investors not only get exposure to those high quality dividend growers like United Health and McDonald's that you mentioned, and then they get that options overlay, which makes the distribution rate close to 5%, very juicy distribution yields. So definitely that explains the interest in this ETF. And you mentioned expansion of your income suite. So I saw that in September, you launched the international version of DIVO, and this is IDVO, Amplify International Enhanced Dividend Income ETF. So tell us about this ETF and why investors should look at these international stocks too.
Yeah, so with the success of DIVO, we began to hear from more professional investors, and that's who Amplify tends to speak with on a daily basis. That's who we really service and really market our products to. And many of these financial advisors said, "Boy, we really like this high quality approach to the U.S. We think it would be great, maybe even more beneficial to have a high quality approach to international securities. Certainly there's a few more risks maybe in the international markets and more volatility than the US, depending on geopolitical events and different types of economic cycles. Certainly this year, there's been a lot more, concerns with, Europe and the Ukraine-Russia conflict, as well as even some of the developments in Asia and the Middle East. So we decided to launch essentially a sister fund to DIVO, which is IDVO, that uses the same security selection approach in terms of high quality companies that are growing their earnings, that are growing their dividends, and then implementing a tactical cover call overlay over that. So working with Capital Wealth Planning, again, this brilliant team out of Naples, Florida, we've created IDVO to allow investors to essentially mimic the approach of DIVO here in the US, but do it on the international side. There's still many investors who value having international security exposure, and we think there is some diversification benefits there. In addition, in this case, because there tends to be a little bit more volatility in the international markets, there's the opportunity to collect a little bit more option income when you write covered calls. And then there are, because it's a bigger universe, looking at many other countries, not just the U.S., there are a little bit more dividend potential kind of companies out there in the marketplace. So what you end up getting with IDVO is a little bit higher yield, about closer to 6% distribution than DIVO. Of course, I wouldn't be surprised if there's a little bit more volatility in international stocks than U.S. stocks. But the thought is that this is a way for you to kind of take your international weighting, become more higher, to upgrade in terms of becoming higher quality, but then in addition, be able to generate some significant income. We talk to many people who own international products that really just don't have much income associated with them. They're really designed to be an allocation for diversification purposes or capital appreciation. And, in this market, trying to earn, a return when, capital appreciation is negative is tough. So to kind of help offset that, being able to collect dividend income and option income, we think was important. The other interesting thing about international stocks is they tend to be a little bit more flexible in their dividends, meaning they're not afraid to postpone dividends or lower dividends. They tend to be pretty dynamic based off kind of the economic environment. So having a strategy that doesn't just collect income from dividends, but also has the ability to collect option income, we think is going to be quite important. It allows kind of a more of a safety net for those who really need that income from their international portfolio, that they don't just have to depend on dividends, which could be postponed or go away at some time in the international markets, depending on different types of economic scenarios. In the U.S., you don't see that quite as much. Most companies tend to be pretty rigid with their dividends, not so in the international side. So kind of a unique, I think, spot for IDVO. And again, just its first few months out in the marketplace, and we look forward to kind of building that track record in that fund.
Another very interesting strategy, and most US investors have very little exposure to international stocks. And as you mentioned, these are more volatile compared to US stocks. So a little bit of exposure to investors who are looking for higher incomes and higher growth potential. That makes a lot of sense. Now, you also launched a natural resources ETF recently. This was in September, I think, or August. So this is the Amplify Natural Resources Dividend Income ETF. Ticker symbol is NDIV, NDIV. And this is your highest yielding ETF for investors who are really looking for that juicy dividend yield. So this has a distribution yield exceeding 9.4%. So natural resources stocks have also done quite well this year because they usually tend to do well during periods of high inflation and rising rates. But there are some hopes now that inflation may be peaking. And today, we're talking on Wednesday, and the Fed Chair Powell just spoke and suggested that we may now see smaller interest rate hikes starting December. So do you think natural resources stocks could continue to do well in the coming year? And also tell us about this ETF.
Yeah, so we're quite bullish on this kind of natural resources area, and the sectors that are represented in at least our natural resources dividend income ETF are energy companies and materials companies. And specifically when you look at like what industries that represents, it's oil, gas, and fuel companies, metal and mining companies, chemical companies, and then energy equipment and service companies. So these are really the lifeblood of industry and kind of economic activity around the world. We certainly saw that this year, as there are some concerns about, energy availability and energy prices with the conflict happening with Russia, and what that does in a very short period of time to marketplace dynamics, because they're really, although we are transitioning to renewable and green energy, we really don't have the capabilities in place to continue to kind of run the world economy just on that, or primarily on that. And while we do see this energy transition happening over the next 20 to 30 years, we really think that these companies in the energy and material space are going to be in a great position. Many of these companies also realize that there is an energy transition happening. And what's happened is many of these companies, instead of spending very large amounts of their profits on future investment, they're instead pivoting to returning cash to shareholders in large amounts. And many of these companies are doing it essentially three ways: either through dividends, or which are something that we're always used to, I think, in this space. Second, variable dividends, which is dividends over and above what they're kind of expecting to pay out. And then third, through buybacks of their stocks, which tends to be good for capital appreciation. So we really think these are kind of cash flow monsters in terms of what they're doing with their profits and their cash flow. Now, on the other side of the coin, they're not totally ignoring kind of renewables, and this portfolio isn't really as well, because remember, it does have metals and mining exposure, and many of these metals and mining companies are mining the metals of the future, these so-called green metals that are the lithium, manganese, copper, etc., that are kind of the building blocks for electric vehicle technology in the form of batteries, and many of these new types of metals and materials that are really needed to kind of build out this energy transition. In fact, 32% of the portfolio in our natural resources Dividend ETF is these metals and mining companies. So, stepping back, this is really, a way to kind of play on traditional energy companies becoming really cash flow monsters in terms of returning capital back to shareholders. And then secondly, also kind of owning these other types of companies. Mostly these are mining and metal companies. However, there are some energy companies within the portfolio that are investing in, green power in the future. But you kind of get this additional benefit of these companies, embracing kind of this energy transition. And what that does is it creates just a large amount of cash flow. So, when you look at kind of what this product is in terms of the natural resources dividend income ETF, it's really U.S. listed energy and materials companies that have at least a $5 billion market cap. So these are large companies in those sectors, and then pay at least a 3% dividend yield. And that's just their regular dividend yield. That doesn't include any variable dividends or special dividends they pay or any buybacks. And then from that universe, the companies are weighted based off their dividend yield, with no company being more than 5% of the portfolio at each rebalance. It's index-based. So you get a portfolio of 53 energy and materials companies that tend to be fairly large in terms of their capitalization, over above $5 billion. And they're yielding, as you mentioned, 9.4% here in our last distribution. So we think this is a kind of a great way to get exposure to energy as a whole. Energy and these companies definitely benefit in high, during periods of high inflation. They also benefit when, the economy is doing well. And let's not forget, one of the reasons the Fed is trying to raise rates and slow down, kind of the velocity of money is because the economy has been overheating and doing quite well. So we think, this is a little bit of an artificial slowdown in terms of economic activity caused by, central banks to protect consumers against inflation, which is great. We think that makes sense in the long term. But, taking that, kind of slowdown approach away, the reason why, the economy is doing well is just we're recovering around the world. And, there's some real bullish activity that coming out of the pandemic that, has been good for the economic growth of the world, including increased use of energy. So we think this is kind of a unique addition to our portfolio. It's probably our ETF that has the most value stock exposure, even more than say a DIVO, because it focuses on that energy and materials sector. And we think it could be a nice addition to a variety of different sleeves in a portfolio, whether it's just an income sleeve or it's a value sleeve or it's a natural resource or commodity sleeve. So we're pretty excited about this and look forward to kind of the next distribution. NDIV, the ticker NDIV, will pay, which will be at the end of the year here in December.
So staying on the energy transition theme for a bit, we have also seen an acceleration in the transition to electric vehicles, or EVs, and they also got a boost from the Inflation Reduction Act. But there are serious concerns about shortages of raw materials in this area, materials of the future, as you alluded to. And you run a lithium and battery technology ETF. The ticker symbol is BATT, BATT. This has been beaten down this year. So tell us what happened to these areas of the market, because there's so much growth potential and they should have done well during periods of high inflation. So tell us a little bit about this ETF and your outlook for this area.
Yeah, so our ETF BATT is, I think, quite an interesting ETF, and this year it's definitely suffered, along with most kind of growth-oriented ETFs. BATT is interesting because it's a mix of really three types of companies. About half the portfolio is dedicated to these battery metals and materials, so cobalt, nickel, lithium. some of the other metals that are mined and used for battery technology. And then the other half of the portfolios, kind of divided between electric vehicle companies and then battery technology companies. So it's really kind of a one-stop play on the kind of electrification of fossil fuels. You get the materials, you get the technology, and then you get kind of the biggest end-use demand case, which is the rise of electric vehicles. So, this year the product has really suffered because, many of these companies, especially in the battery technology and electric vehicle space, came in at really high PEs. They're, definitely, companies that had that fit in the classic growth area, and unfortunately that they suffered because of the move to risk off and the move more towards value stocks. On the other side, though, there some of these mining companies were at lower PEs and allowed the portfolio to hold up somewhat, or kind of acted as a ballast. But no question about it, this is I think a theme that is on sale, in my opinion, here. If you believe that we're moving to, the electrification of fossil fuels, and specifically that, electric vehicles are going to be kind of the, idea or the choice of most consumers in the future. BATT is part of a suite of thematic ETFs that we offer, and we really look at thematic ETFs as trends that have sustainability over the next 10 plus years. And we know that because they're more growth oriented, they are going to have their ups and downs. But we really believe this is a theme that is as strong as ever. And we just point to one metric, and that would be looking at the spending and actions of three key constituents. This is kind of a test we use for each theme, and the spending and actions of these constituents are always important to us. And when they align, it generally means that this theme has not only a lot of, power to continue, but also, potentially some explosive growth behind it. The three constituents I'm talking about are governments, corporations, and consumers. And when you see governments, corporations, and consumers with positive actions on the theme, as well as spending money on the theme, it's usually a good sign that theme has some potential. And when you look at electric vehicles and you look at kind of these the metals that comprise them, as well as battery technology, there's no question that through legislation and spending and stimulus efforts, governments around the world are pushing this industry forward, whether that's new charging infrastructure, or rebates on electric vehicles, or outlawing the sale of internal combustion engines in the next 10 to 15 years in some cases in different nations. Or you look at the corporations, whether it's the automobile companies that are spending the money to create electric vehicle models and really innovate there and expand battery range and all sorts of features related to kind of electric vehicles. The choice of electric vehicles and the competition has never been greater, and the investment by these companies is immense. And then finally, going down to the consumer, our consumers, spending money and looking and considering and buying these electric vehicles, and we're definitely seeing an uptick around the world in terms of some countries bigger than others. China, for example, is really transitioning in a hurry, due to a lot of factors versus the U.S. But the U.S. still is, an important market, and I think second behind China in terms of automobiles. And the U.S. is, making some nice changes too. So we think that this is something that's, an ETF that's on sale, and based off macro conditions, meaning risk off conditions that primarily are due to financial engineering, basically central banks trying to cool down the economy. And that we think that over time, though, these types of companies, whether they're technology, metals and mining, or vehicle companies, offer a lot of upside as these three entities, governments, corporations, and consumers, increasingly embrace and spend money in this area. So pretty excited to have this ETF, and definitely has had, unfortunately, a down year this year like other growth ETFs, but I think we view it a little bit more as being on sale than kind of having lost momentum or having problems in the space.
So definitely a lot of long-term growth potential, and this ETF may appeal to contrarian, value-oriented investors who are looking for longer-term investments. Another ETF which has been out of favor this year, or that's putting it mildly, this has been beaten down. It is the Amplify Transformational Data Sharing ETF. Ticker symbol is BLOK. This is in fact the biggest blockchain ETF, and we know that the crypto space has imploded, particularly since the collapse of FTX. Cryptocurrencies were down earlier this year too, even before this FTX crisis happened. And now there are serious concerns about frauds, manipulation, and lack of regulation in this space. So I was interested in your thoughts on future of these blockchain companies. We know that cryptocurrencies may or may not have a future, but the technology is very, very strong, and that definitely has a future. But normally investors associate blockchain technology with cryptocurrencies. So tell us a little bit about BLOK and your thoughts on blockchain companies.
Yeah, it's definitely been an incredible year in really the cryptocurrency space, which as you rightly said is really kind of the most well-known use case for blockchain technology. And as you mentioned, we started the first actively managed ETF focused in the blockchain space all the way back in 2018, which is kind of crazy to think about now, when most people didn't really know what blockchain was. Today there's $400 million in assets in it, but to your point, this whole space is down in a big way. I think the fund, is down over 50% year to date, and we've certainly seen some, different return sets for our ETF BLOK since 2018, and a lot of that depends on kind of what's going on with, the cryptocurrency market, because many of the companies that we own in BLOK, which is actively managed, have a high correlation to Bitcoin prices, at least. With that being said, we have had a tough year this year, but the fund is still, has a annualized return of just over 2% going back to its inception. So it's been something that's had positive returns going back to 2018, and we're definitely in a winter market place for, number one, growth equities, but then number two, kind of crypto-oriented companies. But BLOK really focuses on companies that are engaged in blockchain technology. So that does include, cryptocurrency. So for example, it will own, companies that are creating the mining equipment to mine crypto or Bitcoin, to do kind of the work behind the blockchain. It does own some of the publicly traded companies that are, doing payments or accepting payments, Bitcoin payments, or doing, exchanges, or, that allow maybe futures contracts on Bitcoin. So there's definitely exposure through the public markets to cryptocurrency via BLOK. But, BLOK also invests in companies that have nothing to do with cryptocurrency, instead are working on private blockchains and applications through blockchain. So, just looking at, for example, the top 5 holdings of BLOK today, they include IBM, Accenture, Overstock, SBI Holdings, and GMO Internet. Some of these companies are creating, like IBM, blockchain technology to use to track shipments or inventory that underlying companies actually license their blockchain technology to do that, and use blockchain privately to keep track of transactions and inventory. Other companies actually run exchanges. Overstock has exchanges, or even developed blockchain wallets. So this is a pretty diverse portfolio in terms of BLOK, and I think what's happened this year has really highlighted, in my opinion, one of the advantages of BLOK. So when most people want to invest in blockchain or crypto, they're probably investing in something that is unregulated or somewhat unclear in terms of how regulators view that. And by that, I mean investing in coins or investing in private companies or, trading or buying and selling those coins on exchanges that are private and maybe aren't fully regulated. That has a very large level of risk, of which we've seen really come to the forefront this year with multiple bankruptcies and potentially even fraud. And that's, I think, the really kind of exciting thing about BLOK is, BLOK being a 40 Act exchange traded fund can only own publicly traded securities that have to meet the standards to be listed on their individual exchange and, are monitored by the SEC and have to produce audited financials. So BLOK is really, at some point people have poo-pooed it maybe because it didn't own individual, some of these unique coins or made private investments, et cetera. But the fact that these are all publicly traded companies that have regulations helps us to hopefully, avoid some of the, larger issues that we've seen this year with some of the fraud that has seemingly happened in the cryptocurrency space. We still think blockchain technology is a technology that could be as transformative as the internet. And this would be in a different way, though. This would be really, creating an automated system of trust, an automated system of tracking, an automated ledger. That's really what blockchain technology is. It creates trust between parties who may not share any commonalities, but maybe just a transaction. So when we're hearing how blockchain technology is being applied, it's starting to be applied into securities transactions, mortgage origination. It's being looked at in terms of voting. It's definitely in place already in some food safety applications. There's just many ways that blockchain technology is going to kind of automate this process of digital commerce. And, like we saw the stock market become digitized many years ago, and it's hard to think of it ever going back to paper. We think that many of these processes that exist today, where some type of middleman or independent third party needs to verify data or transactions, any of those types of situations will be replaced by blockchain technology. So again, we think this is a kind of a 10-year plus runway for the adoption. We think blockchain technology is kind of being thrown out like the baby with the bathwater because of what's happened in the cryptocurrency space. BLOK does own some Bitcoin in the form of Bitcoin ETFs. Actually, the Canadian spot Bitcoin ETFs. I think there's several positions there currently in the portfolio. I mean, it's actively managed, so it does change from time to time. So there is some indirect Bitcoin exposure. There's no other cryptocurrency that is in the portfolio from an indirect perspective. The majority of the portfolio is, by far these publicly traded companies. And, we've been there before. In 2018, when we launched BLOK, Bitcoin was about $19,000. And over the 18 months or so that it first was in the marketplace, Bitcoin went down to about $3,800. So we saw a bear market there, and then certainly saw that run from $3,800 to a little above $60,000, and BLOK was able to participate nicely in that rally. Now we've seen kind of the decline from 60 to, I guess, a little under 20. I think we've been as low as maybe 15 or 16,000 for Bitcoin. So we're in a bit of a winter here, but we think over the long term, BLOK is a compliant, highly regulated way for most investors to have some minimal exposure to this area, which again, we believe is primarily blockchain, of which one of the use cases is crypto, but there are many use cases in motion today that ultimately we think will be just as important and impactful. So BLOK is definitely more for aggressive investors and speculative investors. As we mentioned, it's down over 50% this year. but it's had a positive return since its launch in 2018 from an annualized perspective. So something to take a look at, and something that's regulated that you can buy in your brokerage account and not be fearful of, having unregulated securities or odd types of business risk that you'd find with companies or assets that aren't publicly traded or registered.
Yeah, I agree with you on the potential for blockchain technology. It's an amazing technology. That's all we have time for today. Christian, thanks so much for joining us today. Always a pleasure to have you on the show. And thanks as always for your insights.
Thanks so much, Nina. Good to speak with you, and look forward to speaking with you soon.
So that was Christian Magoon of Amplify ETFs. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our podcast so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.